You're scrolling through real estate listings late at night, and every halfway decent house costs around $500,000. Outdated kitchens, beige carpets, unfinished basements, and somehow it's still called a starter home. You start wondering if you missed a promotion or if the housing market has completely lost its mind. Spoiler, it's not you, it's the math. My name is Susan, and today we're breaking down who can actually afford a $500,000 house in 2026. Not who gets approved by a bank, but who can buy without living in constant financial stress, because approval and affordability are not the same thing. In many U.S. markets, $500,000 is now the baseline, not luxury, just normal. Meanwhile, the median household income is about $84,000. That's people being asked to buy homes that cost 6 times their annual income. If that sounds extreme, it is. But lenders say it's fine. Social media makes it look easy. And that's where people get misled. The reality starts hitting with the down payment alone. A traditional 20% on a $500,000 home is $100,000 in cash before you even think about monthly payments. The median savings in America is about $8,000. So you're not a little short of a down payment, you're $92,000 short. And even if you somehow save 10% of an $84,000 income, that's $8,400 a year. At that pace, it takes over a decade to save $100,000, assuming home prices don't keep rising. So most people put down 5 to 10% instead. And that's where PMI shows up. Private mortgage insurance is an extra $200 to $400 a month, paid solely because you couldn't afford 20% down. It protects the bank, not you. Now the mortgage itself. With 10% down, you're borrowing about $450,000. At today's rates, that's roughly $2,800 a month just for principal and interest. No taxes, no insurance. Add property taxes, about $500 a month. Add homeowners insurance, another $250 to $350. And suddenly, the affordable house is costing far more than the listing ever suggested. Then there's maintenance, the cost everyone ignores until something breaks at the worst possible time. A common rule is 1% of the home's value per year. On a $500,000 house, that's about $400 a month. Add PMI back in, another $300. Now stack it all up. Mortgage, taxes, insurance, maintenance, PMI. Your total monthly housing cost lands around $4,400. And that's assuming nothing major goes wrong. Financial advisors say housing should stay under 28% of gross income. At $4,400 a month, that means you'd need to earn around $187,000 a year. Even using the bank's looser 43% rule, you still need about $150,000. Only a small slice of households make that much. So who's buying these homes? Some have dual high incomes, some have family help, and some are stretched so thin that one bad month could wreck everything. Take a household earning $160,000. After taxes and basic deductions, they're bringing home about $9,500 a month. Subtract housing, and they're left with just over $5,000 for everything else, including 2 car payments, which alone can wipe out hundreds immediately. Car insurance for 2 cars adds another $250. Gas, because suburbia isn't walkable, $300. Student loans, $600. Health insurance premiums, $400. Groceries for a family trying to eat decently, about $800. Utilities for a larger house, power, water, internet, phones, $450. That leaves roughly $1,500, and we still haven't touched clothing, kids' activities, car repairs, medical bills, or saving anything meaningful. No real emergency fund, no breathing room. This household is spending nearly half of their take-home pay on housing. Not because they're reckless, but because this is what the market calls normal. Day to day, it feels like checking your bank balance before groceries, saying no to small expenses because something bigger might break, lying awake at night hoping the car holds together one more month, one surprise bill, HVAC, accident, medical expense, and it's going on a credit card. And this is a household making $160,000. Now imagine trying to do this on $120,000, $100,000, or the actual median income of $84,000. At that level, a $500,000 house isn't tight. It's a financial fantasy. It's mathematically impossible without outside help or accepting a level of risk that would terrify most people. And here's the part no one likes to admit. The system doesn't care. Sellers list homes at $500,000 because that's what the last one sold for. Banks approve loans at 43% debt to income because the mortgage probably won't default right away. Agents push buyers to stretch because their paycheck depends on closing. No one involved is rewarded for telling you this will wreck your finances. The goal goal is to get you into the house, not to make sure you can afford it long term. And once you sign, you're stuck. Walking away means destroyed credit and lost cash, so people stay. They stay in homes they can't afford, in jobs they hate, watching their savings disappear while wondering why they feel constantly anxious in their dream home. Here's the hard truth. For 70 to 80% of households, a $500,000 home is not sustainably affordable. This isn't personal failure. It's math. Home prices are up roughly 400% since 1990. Incomes, about 180%. That gap doesn't close with budgeting hacks or side hustles. You can't budget your way out of a broken market. You can't manifest lower interest rates. What you can do is look at the real numbers and make a conscious choice. Rent and invest the difference. Buy less house. Or accept that ownership in your market just isn't viable right now. And that's okay. There's no prize for being house poor, no trophy for stressing about every bill. The real question isn't whether you can get approved for a $500,000 house, it's whether owning it will actually improve your life. I don't care what the mortgage broker says you're approved for. I don't care what your agent claims is normal. And I definitely don't care that your friends somehow made it work. The numbers don't care about your feelings or your dream kitchen, but people ignore this all the time. They stretch. They bet on future raises. They plan side hustles that never really happen. Or they're just exhausted from renting and want out so badly that logic disappears. So they buy the house. At first it's fine. The payments go through, you cut back, skip a few things, tell yourself it's temporary. Then reality shows up. The car needs repairs. The AC dies in the middle of summer. Someone's hours get cut. Every surprise goes on a credit card because there's no room to breathe. That's what being house poor actually looks like. You technically own a home, but you can't enjoy it. Every decision becomes, can we still make the mortgage? Every expense is a mini crisis. You're not building a life, you're servicing debt. And the most twisted part, we've normalized this. We call it adulthood. We call it just how it is. Living stressed, broke, and trapped gets rebranded as building equity, while the math is screaming that something is deeply wrong. Culture tells you to buy anyway. The numbers are begging you to stop. Never mind that your parents bought a home for 3 times their income and today you're being asked to buy one for 6. Never mind that you have no idea whether your friends are thriving or quietly drowning behind that freshly painted front door. We're told renting is throwing money away, as if being trapped in an unaffordable mortgage isn't also throwing money away, just with more stress and bigger consequences. So here's the radical option. You can choose not to play this game. You can look at a $500,000 house, run the real numbers, and decide it's not worth sacrificing your peace, your flexibility, or your future. You can keep renting. You can save, invest, wait, move, or simply opt out for now. And none of that means you failed, because real wealth isn't barely surviving a mortgage. It's margin, it's choices, it's sleeping at night instead of stressing over the next payment. Banks, agents, and insurers all make money when you buy, not when you make a smart decision. If the math doesn't work, walking away isn't weakness, it's clarity. A $500,000 house isn't a starter home on a median income, and there's no prize for owning something that makes you miserable. The real win is choosing reality over pressure and refusing to sign up for a life you can't actually afford. The bank's approval and your ability to actually live aren't the same. Maybe in a few years your income rises, the market corrects, or you move somewhere cheaper. But today, with current prices and wages, the math doesn't work for most people. So here's the advice. Stop focusing on what you qualify for and start looking at what you can truly afford. Mortgage, maintenance, savings, retirement, without constant stress. For most, that number is far below $500,000. That's okay. You're not failing. You're being realistic. The market will keep pretending these prices make sense, but sometimes the smartest move is seeing the game is rigged and choosing not to play.